Hey traders, it's Stephen Brooks, and today we're going to be talking about VXX and specifically why I never, ever, under any circumstances whatsoever, will buy VXX or UVXY for that matter. Now, I understand that the reasons why individual traders and investors might buy a VXX or a UVXY, that is typically quite sound. The idea is most individual traders and investors only have long positions. They're basically only long stock or long call options. So the idea is the way that is less effective is when the market sells off. When the market sells off, the stock market, typically we will see an increase in volatility that hits the VIX, and the idea is that it also hits VXX, which is 2 times VIX, and UVXY, which is 3 times VIX. So the idea why a trader might want to get some long exposure to a VXX or a UVXY, that makes a lot of sound sense. However, the execution is horrible. And let me explain why the execution is horrible. VXX and UVXY, you have to understand how they get their price. It is not specifically just based off of VIX. The way VXX and UVXY get their price is as follows. Now, I'm going to break it down to a really basic form. This is not exactly to the T of how they do it, but this will give you a very good understanding of how they actually maintain the price for a VXX or a UVXY. Here's what happens. VXX will take a basket of 10 futures contracts. VIX futures contracts. Now, it's not 10, it's way more than that, but this will just be an example that everyone will be able to understand. So the idea is at any given time, VXX is more or less a bundle of 10 VIX futures contracts. Okay? Now, as we go, what happens with VIX futures contracts is they have ones that expire in 10 days, in 20 days, in 30 days, etc., etc. However, at some point, these contracts, they all expire. That's very, very important to be able to understand how we get the price of VXX. Every VIX futures contract at some point expires. And this is where it becomes a very interesting situation. When these contracts expire or are getting close to expiring, what has to happen? Remember, they have to maintain this bundle of VIX futures contracts in order to get that price for VXX. So what happens? They will sell these shorter dated VIX futures contracts and buy a further out dated futures contract. That's how they're able to maintain these products. Here's where the problem lies. 80% of the time, folks, 80% of the time, the back month or the further out VIX futures contracts are trading at a higher price than their short-term dated VIX futures contracts. So as an example, 80% of the time, this is what the VIX futures price chain looks like. Let's say right now it's at 12, and then 20 days from now it's 12.4, and then 13 days it's 12.9, and then 40 days it's 13.5. 80% of the time, this phenomenon happens. This phenomenon is called contango. I didn't make it up because it wouldn't make any sense for me to call it that, but they call it contango. The idea of contango is that the further out in time we go, the higher the price of the futures contract. This, again, happens 80% of the time. I'm going to get a red pen because it's about to get bad. This happens 80% of the time. So, again, VXX gets its price off of these futures contracts. These futures contracts expire at some point, and 80% of the time, the further out VIX futures contracts are traded at a higher price than the shorter dated ones. So what has to happen is, in order to maintain this product, and this one over here as well, they have to sell lower priced VIX futures contracts and buy more expensive, further out VIX futures contracts. 80% of the time, just to maintain the product, the owners of VXX have to take a loss. just to maintain the product. Again, the idea of why you might actually go in there and want to buy VXX or UVXY makes a lot of sense, but what some folks don't know is their execution is horrible because they don't know how VXX or UVXY, for that matter, gets its price. 80% of the time, just to maintain the product, the people who maintain the product, I think it's Deutsche Bank, but I don't really know and I don't really care. But 80% of the time, whoever maintains this product has to take a loss just to keep the party going, just to make sure that this is still a tradable product. So what does that mean for you? That means that 80% of the time, VXX and UVXY will have a negative drag against it. 80% of the time. That means 80% of the time that VIX goes higher, VXX will not go as high. What it means is 80% of the time that the VIX is flat, VXX and UVXY will be down. So, why do I never buy VXX or UVXY? Because I don't know about you, but in what world would it make sense for me to buy something where, in case I want it to go higher, that has a negative drag against it 80% of the time? That's just me personally speaking, and I don't know anyone in the entire world that would do that as well. So again, folks, the idea of getting long a volatility product, because most people are just long stocks, and they're mostly just long options, the idea to hedge off that risk via the market going down, volatility going higher, that makes a lot of sense. But the execution is horrible. Why? Because 80% of the time, there is a negative drag against a VXX or a UVXY because they have to sell lower priced VIX futures and buy further dated, higher priced VIX futures just to maintain the product. Now, so you might be saying to yourself, well, Stephen, there's like a 20% in here where it's really beneficial. Great. I've never met and I've never been able to time the market so perfectly at all where you can figure out when that 1 time out of 5 is, or that 2 times out of 10, or that 80 times out of 100 is. I've never seen anyone in the entire planet that can time the market so perfectly, and I'm sure that none of you out there have. So again, unfortunately, while the idea of why we might get long a VXX or UVXY is very sound, the execution is horrible. Why? Because the product has an 80% of the time has a negative drag against it. Now, this is not something that is brand new. This is something that is very known. How do we know that this is known? VXX and UVXY are none to borrow, and this is such a good deal that there are shorts that are never going to get out of their positions. Thus, there are no shares to sell. That's how good it is. There's only a couple people that are in on the party, and for everyone else, it's very difficult. So again, I never buy VXX and UVXY because it has an 80% drag against it. It has a negative drag against it 80% of the time because it has to in order to just maintain the product. So I hope this helps a lot of folks. I'll see you all in the next video.